at the end of last year, we received our zero carbon design certification. So that some of this was new to me. I think it's fascinating. We're using geothermal to kind of allow us to be zero carbon. And what that means is on this piece of land, there are 145 boreholes that are drilled 850 feet down. So we're sitting in a tower that's 69 feet. That's kind of higher than that. And there's, 145 of them. And basically through those, that kind of vertical drilling that will generate enough energy to meet all of our space, heating, cooling requirements, as well as domestic hot water. So it's pretty neat, and it's sufficient to support the phase 2 on this piece of land, which is another 641 units, or 391 affordable.
Ladies and gentlemen, my name is Fragale, and you're listening to Working Capital, the real estate podcast. My special guest today is Aliyah Mohamed. Aliyah is the Chief Capital Officer at KingSett Capital. She joined in 2022 and has oversight of equity and debt capital strategy and formation, as well as marketing and communications. Aliyah, how you doing?
I'm good, thank you. Thanks for having me today. Nice to see you.
Nice to see you as well, and it's my pleasure. I think it'd be interesting to kind of, for the first podcast of the year, to talk a little bit about the Canadian market and a Canadian company. But before we start here, for listeners that are unfamiliar with yourself and KingSett, we can talk just a little bit about how you got into real estate.
For sure. I would say I took the scenic road. I'm a science student, found myself in investment banking out of business school, worked in the M&A group on a certain sector of deals, largely communication and media. And when I was away for a few months on maternity leave, I came back, and the deals that I would have normally worked on were well underway, and a real estate deal rolled in. And it was a new sector. I'd never worked in real estate, a new kind of senior partner, just settling back into work. And it was a bit daunting to take it on, but it was a good technical assignment. And it led me to very quickly another large corporate privatization, where our client happened to be KingSett Capital. That was a phenomenal deal from an M&A practitioner's perspective, met an amazing team. It was super exciting. And then, as luck would have it, another real estate deal rolled in. And after the third one, I was hooked. So I moved from the M&A group to the real estate investment banking group, learned a little bit more about, banks' products. And then I was very fortunate a few years ago now, to, end up talking to KingSett about a really interesting position that I think if I had designed it, I wouldn't have believed it was possible. So that's how I found my way into real estate and KingSett.
So before KingSett, you were at TD on the investment banking side. In terms of the deals that you oversaw, predominantly non-real estate?
The initial years of my career, yes. So there were some really interesting broadcast deals at that time with Shaw, CanWest, BCE, CTV, some in the industrials, some in the technology field. But that was largely how you got staffed, and I happened to get staffed on those deals. And then, capacity available, real estate deal came in, and it kind of shapes your path sometimes. When that deal finishes, you're available for the next one, and so your path is somewhat given to you, and sometimes it's great when there's a window opens or there's a little bit of luck or shifting, and if you lean into it, some interesting things happen.
It's funny. We've done interviews with probably over 150 people now, and I would say 90% have a non-straight path to real estate. Yeah. There's a lot of different backgrounds, and similar to you, I noticed online prior to business school, like I went to school for philosophy. The trajectory I was going to go on was completely different, and I saw neuroscience in your bio, and I always remember a lot of the philosophy groups started to merge with neuroscience groups, or they were like
interesting.
Yeah, cross-pollinated between like philosophy of the mind and neuroscience. So I thought that was cool.
That's neat.
In terms of so the move to KingSett, it probably feels like yesterday because it was 2025 already, and it looks like you've been there now, I guess, 3 years with KingSett. Can you talk a little bit about the role itself? Because I think when people see chief investment officer as opposed to chief capital officer? What's the, you alluded to, if you created the job yourself, what are those unique aspects that you're talking about?
For sure. I would think about my role as focused on the right-hand side of the balance sheet. So, long before I joined, there's an amazing team in place at KingSett that can take capital and buy real estate, move it over to the asset management team who looks after it, back to the investments team who would sell it, or another part of our business where you take capital and you lend it out to a borrower, a senior mortgage loan, a high yield loan, and then that capital gets repaid, all of which earn sustainable and premium risk-adjusted returns for our investors. And so that part of the business has been in place for decades, performs amazing. And I get this, great opportunity to come in and, work with the results of that team, but focus on managing our sources of capital. So whether that's equity capital from investors for our different fund strategies, or it's debt capital from the Canadian banks or the other banks where we're the borrower and working with lenders. And so it's a great spot where you get to see all the different business lines, work with all of the different groups within KingSett, and really focus in on, are we well structured depending on the different fund strategy? How do our investors feel today? Where are they headed? What are their concerns? What are the opportunities in the market for, need for an investment solution? How do our banks feel? So it's this really broad role where there's finance and analytics involved, but there's also a lot of relationship. And so there's a great breadth. And there's, as a secondary piece, some consideration around our communications and marketing, just because it's primarily used for those external sources of capital.
So in terms of, it's a good segue into KingSett itself. Large company, I think, especially these Canadian real estate companies, we think they do one thing and then you realize that they do a completely different thing. Before we talk a little bit about the strategy when it comes to capital raising and some of the funds, for those that don't know much about KingSett, just high level, what exactly KingSett does? Like what is the main focus of the business?
For sure. No, it's a great question. So we are a private equity real estate investment business. And we have a broad portfolio of real estate investment solutions, which, we work to deliver from those solutions sustainable premium risk-weighted returns to our institutional as well as our high net worth investors.
In terms of the institutional clients that you have, is that just across the board in different industries? Do you focus on specific industries when it comes to the institutional?
We right now we have some great relationships with a number of large and medium-sized pension funds. That's actually the foundational investors for KingSett going back to 2002 were pension funds. Our founder, John Love, who's, built up Oxford Properties, which was then privatized when he came back after taking I think he describes it as going dark for 6 months. When he came back and was just trying to understand, what was the opportunity in the market at that time. Some of his observations were that there were large, sophisticated institutions that had a great capability to invest directly into core real estate, and they had a team structured to make that kind of an investment. They also had an allocation for growth or value add real estate, but it needs a very different execution team and capability to perform that kind of investment. And so, the original KingSett fund was what we call a growth fund, but it's a value add opportunistic closed-end fund. And he designed an execution team and to support that kind of investment thesis. And those, initial institutions that, worked with us to start the company in 2002 are still some of our larger investors today. So they've grown with us over the last 2 decades, in that existing strategy and then through other strategies at KingSett.
So real estate, as you know, is a very cyclical business. When I started, industrial was not the hottest product in the world, and that's changed over the last few years. Since inception, has the asset class that you get these properties in, has that changed just with different economic landscapes changing over the last 20 years?
For sure. I think to answer that well, I'd have to say that it does depend on which fund strategy we're talking about. Just to stick with the growth fund, as an example, they're closed end, and so you're acquiring, you manage, create your value, and then you're disposing. And while you're selling one vintage, you're starting to invest in the next vintage. And if you look back over the last several vintages, so let's say the last decade, for sure you can see that the composition of assets within each of these vintages, the mix is completely different. So, we're on vintage number 8. If you go back to 7, the composition, there was a lot of multi-res, a lot of industrial, some land. If you go back to 6, there was a good component of office, and so forth. And if you compare that to the vintage that we are investing in right now, I would describe that as having still some industrial, a certain type of industrial, and lots of high cash flowing assets. Just given the nature of the market right now, you're able to, acquire at a certain yield and finance at a certain yield and generate, a good portion of your return just from holding the asset, from spread investing. So a very different look and feel to number 7, number 6, and so forth. And then if, you go across different strategies, they would all have a different orientation in terms of the asset mix. At a high level, if you just step back and think about it organizationally, we are a Canadian investor, meaning all of our assets, properties, and loans are within Canada. But within Canada, we'll invest across all markets, all asset classes, and even all parts of the capital stack.
So in terms of, on that point with Canada, you've obviously come across different deals at TD and as well as at KingSett. Is there something specifically different with Canadian investing that you've seen over your career as opposed to U.S. investing? I know KingSett is Canadian, but just kind of borrowing on some of the experience you've had on the investment banking side.
I don't have direct experience with asset level investing in the US or in any other market, but just there are different dynamics in the Canadian real estate market and the US real estate market. So I think that's important to recognize. And sometimes we get so much of our media and headlines from south of the border, it feels like the same thing is happening on both sides of the border, but really it is quite different. We have some different underlying drivers, such as our financial system, the more kind of supply constraint oriented environment that we operate in. People move around less, businesses move around even less. So, some fundamental differences between the two markets. But then I think, what's important from our perspective is, we are a values-based organization, and our, primary or most important value is relationships. And, if I look around the team, that's been together for 10, 15, 20 years, all working in Canadian real estate, the net result is an amazing breadth of relationships across different asset types, markets. You could almost go to someone in the shop about some building and probably someone's touched it, whether they've leased it or they've acquired it or they've worked on, they've lent to it. And I think that starts to become really powerful. Especially if you maintain their different relationships within the industry, just that collective, intellectual knowledge is quite interesting. And if you think about, okay, well, let me go start investing in Seattle, where do you even begin? Versus being in an environment where there's this great kind of opportunity gathering system, deep relationships. So it's a very, I think it's more than just the geography. You put the underlying macro drivers as well as the depth and kind of length of experience together. and Canada still has a lot of opportunity in it. So,
Mhm.
um,
No, that makes sense. In terms of the fund structures, again, from this is just coming from the brokerage side. I find the private equity world, the real estate private equity world, somewhat opaque to us, just because we come across you guys as owners, but in terms of actually seeing under the hood, is more rare. But when you're starting a new fund, is it always a closed end fund? Or are there instances where you will do capital raisings for asset specific or portfolio specific?
that's a great question. So we have a mix of closed end and open ended funds. Um, if I very simply think of the business as having three pillars to it, the first pillar would be that closed end type opportunistic fund strategy, and we have a few of them. That we also have a few open ended equity strategies. We've got a core income fund and affordable housing fund, which I think is becoming one of the more exciting funds, just given a number of reasons. And then just the third pillar would be our credit strategies, which are also open ended. We have a credit team that's through 40, maybe pushing 50, and that's part of the business that started in 2006 and has grown very steadily over the last 20, almost 20 years.
Mm-hmm.
And so the closed or open-ended nature of the fund, should support the thesis. And so if it is to extract value and move on, closed end makes a lot of sense. But if it's, owning an asset like Scotia Tower Plaza that you want to own for generations, better suited to be in an open-ended fund.
No, that makes sense. I don't know if you're alluding to this, but for listeners that are in the U.S., a lot is happening in Canada. The fact that we're in the news either is a great thing or a terrible thing. Justin Trudeau recently resigned. We had a bunch of resignations for different positions in the government. In terms of the actual political landscape, I wanted to just segue from that into affordable housing because I thought that was interesting, and it does seem like an exciting piece. A lot of talk about affordable housing in both the U.S. and Canada. Could you talk a little bit about that fund and I guess also the name, why specifically it's the affordable housing fund?
Affordable housing fund. We're maybe we could be a little bit more creative with some of our names. They generally just say what we're doing.
Yeah.
So that the mandate here, and just for some background, this fund was initiated in 2020. So we're at a very exciting time now, but there was several years of some darker days where we were just trying to figure out how to make this work. That the mandate that drove the creation of this fund was just to create a scale portfolio of hopefully all net zero urban housing communities with a meaningful affordable component. So not the minimum affordable, but the maximum, that the best that we can do. And the intent was to drive healthy, stabilized yields that would provide a return to our investors, a return level that could actually attract capital to support the strategy so that we can get to scale. And so, since then, we acquired one property with a fantastic partner, Mahogany. The entire building is all affordable, and about a third of the units are deeply affordable, meaning they're not just workforce but kind of social housing with agencies on site. But the balance of our portfolio are all developments. So we broke ground just the beginning of last year on a project in Etobicoke, Valhalla Village, phase 1, 494 units, of which 172 are affordable. At the end of last year, we received our zero carbon design certification. So that some of this was new to me. I think it's fascinating. We're using geothermal to kind of allow us to be zero carbon. And what that means is on this piece of land, there are 145 boreholes that are drilled 850 feet down. So we're sitting in a tower that's 69 feet. That's kind of higher than that. And there's, 145 of them. And basically through those, that kind of vertical drilling that will generate enough energy to meet all of our space, heating, cooling requirements, as well as domestic hot water. So it's pretty neat. And it's sufficient to support the phase 2 on this piece of land, which is another 641 units or 391 affordable. We have a number of other projects that have either just broken ground or are under contract. And so we're feeling momentum. We've made a lot of progress, but it took a few years of just starting to understand how to work with all the different programs that are out there. There's a lot of focus and attention, but sometimes the programs are less than clear, or they're a bit complicated to navigate. How to navigate the financing, which is a critical piece. Again, great programming offered by CMHC, but it took the better part of a full year to get our initial financing in place because of the complexity. And ultimately, we have a dedicated team. It's run by Jeff Thomas, our head of development, but a dedicated team to just continue to monitor all the different programs that are coming out and understanding how to work with them and incorporate them into a design that's economic and can drive return, so that we can continue attracting capital and building more. So I think there's some great potential here. It's a very complicated ecosystem to work within. But if we can keep moving forward, we think we can I think we are already starting to make an impact with our plans, but it'll be great to see them finished, occupied, while we have more underway and coming.
Yeah, and it's interesting too. Again, from the U.S. perspective, I guess our Crown Corporation, CMHC, would be akin to Fannie Mae, Freddie Mac, with a slightly, a different mandate, and affordable housing is part of that mandate. In terms of the programs you're talking about, we've seen over the last few years, and you've seen MLI Select program, different programs that they roll out. But yeah, I never really thought about that. When you're doing a fund specific to that, you have to really, the thesis relies on these programs working the way that you think they're going to work.
Yep.
So in terms of just back to kind of the boots on the ground piece of this, when you go with a fund like the Affordable Housing Fund, in terms of acquiring, I'm assuming you're using different partners on the operational end. What does that look like to actually find the properties and do the asset management or even the property management of the properties?
Yeah, so we outsource all of our property management. We do have a dedicated in-house asset management team. I'm looking over there because that's where they're right sitting. So it's just instinct. Mm-hmm. And part of the role of the group that focuses on this fund is developing, finding and then developing some of the partnerships. For example, with that group, the building that we acquired, if we could have 100 of that, type of individual and group, we would love to do more. But identifying, finding, building relationships takes a bit of time. And then beyond that, in terms of looking at new sites or new partnerships, it's both the dedicated team as well as our equity investments team. So just from a structural perspective at KingSett, we have one investment team, and they look after all of the acquisitions and dispositions for all funds that are equity oriented, which I think is really constructive because they see a lot of deal flow, but they as well would be supporting the affordable housing team by identifying and working through transactions.
So Leah, in your various funds, I'm not sure if this would be in your kind of department, but when it comes to taking a look at a portfolio wide, which assets to keep, which assets to do to have dispositions, is that something that you say do quarterly or annually, where you look at what you want to sell, what you want to keep, if you want to change anything at all within the fund?
There's definitely a very in-depth quarterly process, but I would say there's an investment committee meeting 8:30 Monday morning every week, and everything that's in some form of transaction, buy, sell, prospect, as well as everything that's on the 2025 plan is reviewed every week. Every potential transaction's got an owner, there are dates. It's a very efficient meeting. It's definitely a way to get things started on a Monday morning.
Yeah, no, that makes sense. I just want to step back a little bit and talk about just the general outlook right now, in terms of what you're seeing in the market as opportunities, whether that's asset class, geography, use. What do you guys? What's the economics hat look like right now?
So it's definitely an interesting time in the cycle. Although I would imagine that anybody you speak to at any time would kind of make that comment. What's most interesting for us is we continue to see this, dislocation between operating fundamentals and investment fundamentals, and the operating fundamentals have been quite steady, and so that's really positive and that's constructive. Our buildings are generally full, tenants are generally paying rents are generally moving forward. There is a very constructive path that the operations have been on. The transaction market has been challenging and has been challenging for some time. So, where we are transacting and where we see, opportunities right now and over the past several months has been smaller deals. The larger scale transactions, those have been quiet for some time. So we've been doing a lot of transactions from a volume perspective, dollar amounts a little bit less. We're still seeing good transactional activity in the multi-res sector, in the industrial sector, more focused on users versus institutions. I think we're expecting to see, and I would say, grocery anchored or service oriented retail as well. And that's been really constructive, and some good volume there. What I think, would be very interesting is starting to see some of the larger, higher quality properties come to market, mostly held by institutions. And it feels like perhaps we're kind of getting to a point where, appraised values have done what they've done. There's a desire to move forward and reallocate or shift or do whatever makes sense for that owner. And perhaps we're going to see some more transaction volume coming in that form, which I think we would find very interesting.
So on that piece, if I'm reading that correctly, in terms of like what we've seen is there is still a bit of a gap between the bid ask, and ownerships have held on to some assets, and basically not take the write down of actually selling. So I guess specifically, if we go into what is probably has been the most challenging market or asset class on the office side, in terms of acquisitions in the Canadian market right now, are we seeing ownership just kind of hang on to these assets and not want to write down the value through a sale, or is it more so that you're just finding the transaction volume is just not there for some of these assets?
Yeah, I think the transaction volume is just not there. It's values have come off across the board in office, and kind of where we started, which is operating fundamentals and transaction values. The lack of transactions impacts the ability for appraisers to have good data and with which to value buildings. With all the uncertainty, there's a trend that we've been seeing. So all of our, in our core fund, our properties are appraised every quarter by third-party appraisers. We get what we get. And so it's been a really interesting dynamic to see, space getting leased, good leasing activity, deals longer, net rents, inducements stabilizing, coming down, everything, the net rents for space being taken over by a new tenant is greater than the expiring tenant. Everything is going kind of in the right direction, but yet, we're being told our building's worth less. So it's been a funny dynamic. And so, it really depends on how each individual owner values their property and what their ultimate strategy is. But there's, and I think this is, interesting for this particular cycle, because the operating fundamentals are steady. There's no need to transact. Your tenants are paying you rent. Your banks are still lending you money. And so there's no need to transact. And so if there isn't a great receptive market, there's no urgency or nothing kind of driving that. And I think, we describe this period as being a bit of a capital recession. Mm-hmm. Certainly not an operating recession, which would be more akin to past cycles, but a capital recession. And so, when we we need to see that transaction volume pick up, the capital flow pick up, and it'll sort itself out. But there's no, because the operations are steady, it's taking perhaps a little bit longer.
Yeah. It's funny, doing this, whatever it's been now, 13, 14 years, when we had a hockey stick graph of just everything was going up, interest rates kept going down. I think at a certain point, we were going to feel the pain, whether it was going to be a long period of just low transactions or actually, what people, projected years ago, an actual huge recession, which didn't come to fruition. But it does feel like something had to give in for this, for capital being so cheap for so long, and asset prices. We saw cap rates when I first started in the twos, or even a few years in the high twos on institutional stuff, which is like, why not just put your money in a stock index at that point, and don't deal with the operations. We're just coming up on time here. I want to just wrap up in terms of the outlook for the team. Is there, we touched on a little bit in that last question, but in terms of opportunities, are you going into different areas with the business, or is it kind of steady as she goes right now?
It's been fairly steady. I think the Affordable Housing Fund was 2020. We did a residential development fund after that. We got into the CMHC business after that. And so, what is, tends to be steady is every couple of years, there's either a need from a capital group that, inspires a new fund strategy, or there's an opportunity in the market that we think we can coalesce capital around. So we're always energized and interested in new strategies or solutions. Whether they take place, whatever the timing is, it'll be what it is. Other than that, the business is, there's a lot going on. We've got a growing team. We're doing some great work on decarbonization. That's pretty interesting. There's more than enough to focus on in the meantime.
We can keep waiting for those rate cuts to come along intermittently.
Yeah, I think rate cuts, perhaps a change in political leadership. I think it's going to be a really interesting year. There's a lot of uncertainty south of the border. And so, I would expect if we were to happen to connect the beginning of next year, there'll be a lot to reflect on. And I think we will probably be in a, quite a different space than we are in today. So we're looking forward to seeing how this year plays out. We're quite optimistic that, perhaps some of these changes, the interest rates, maybe some of the uncertainty kind of becomes less uncertain from the south of the border. We know where we stand. Maybe with a change in Ottawa, we get back to a path that takes us or is focused on prosperity. Like it, we've got capital, we've got some, great investor relationships, bank relationships, a wonderful team, that kind of lives our values and is focused on doing what's right for the business and all of our customers. So I think, this could be a pretty, hopefully a constructive, and a really positive year.
Well, they said survive till 25 for a few years, so we're here.
We're here.
We can make something of it. One thing we ask guests, just for, just from an advice perspective for individuals coming into our industry, whether that's in your world on the private equity side, other areas in real estate, what would your advice be for that individual? And maybe that could be colored a little bit because just given the fact that you're a female that is commercial real estate, private equity, and been investment banking. So I think you've probably been outnumbered on the gender side for a while. And as we hire, especially at Avison Young, more diverse employees, I'd love to just get your thoughts on that. Maybe it doesn't color at all, but I thought get your thoughts there.
For sure. I think, there's so much great advice, show up, ask questions, all that good stuff. I think what I tend to share with people that I'm having coffee with, I talked to my daughter about this already. I don't know if she appreciates that just yet, but maybe one day. I would just encourage everyone, male, female, but for sure, I wish I'd followed this advice a lot sooner in my career, just to to stand in your own shoes and not worry about what everyone else looks like, sounds like, speaks like, what hobbies they enjoy, but kind of, understand yourself and be comfortable kind of just being a little bit more true to what your preferences are, where your strengths are, not worrying so much about, where the growth opportunities are, because everyone's going to lean into those and grow naturally. So take away some of that stress of thinking you have to be like or look like, and, just show up and be, happy, proud, confident to stand in your own shoes, whatever they may look like.
My guest today has been Aliyah Mohamed. Aliyah, thanks for being part of Working Capital.
Most welcome. Thanks for having me.